In this video, we're going to be looking at some of the basic principles related to cost, volume, profit analysis. The first thing we're going to look at is this item called the contribution income statement. The contribution income statement is a little bit different than your regular income statement. In a contribution income statement, we start with our sales. We're going to subtract out our variable expenses. You're going to end up with something called the contribution margin. Now, both sales and variable expenses are going to change in proportion to the quantity sold, whereas your fixed expenses are going to remain fixed regardless of the quantity sold. So what we end up with this contribution margin is it shows us, after we take into consideration our sales and our variable expenses, how much is left to contribute to covering fixed expenses and net operating income. So if you take your contribution margin minus your fixed expenses, you will end up with something called net operating income, which we can also call profit. Now let's look a little bit more detailed at this contribution income statement and how this might be calculated. Sales can be calculated by taking your quantity sold times the selling price. This is the price per unit for which we are selling the item. Variable expenses can be calculated by taking the quantity sold times the unit variable cost. This will be a given. Somebody has already calculated this for you, and they will tell you what the unit variable cost is. If you take your selling price minus your unit variable cost, you're going to get something called the unit contribution margin. If you take the quantity sold times your unit contribution margin, you'll end up with your contribution margin. Once again, if you take sales minus variable expenses, you get a contribution margin. Contribution margin minus your fixed expenses gives you your net operating income, also called profit. If you wanted to calculate something called the break-even point, you would set net operating income at 0. So the break-even point is where the contribution margin equals your fixed expenses. We need to have enough in the contribution margin to at least cover fixed expenses to break even. There's another concept called the margin of safety. The margin of safety is where your actual sales exceed your break-even sales. Or you could also look at the margin of safety as units. What are the actual units sold minus the break-even units? So you need to be able to calculate break-even sales and break-even units. Another concept related to contribution margin is this concept called contribution margin ratio. It's just another way of talking about the same thing. If you take your contribution margin divided by your sales, you'll get the contribution margin ratio. You could also take the unit contribution margin minus the unit selling price to get your contribution margin ratio. This is the contribution margin per sales dollar. For every dollar of sales, how much do we have to contribute to fixed expenses? A formula that would also work is if you take the contribution margin, we're going to take the sales times the contribution margin ratio. This will help us to calculate different items that we're looking for when we're doing this internal analysis.